Have you ever bought a stock simply because someone online said it was undervalued? Or maybe you've stared at a company's share price, trying to figure out if it's a bargain or a trap. The truth is, most beginners dive into investing without understanding one critical skill, knowing what a stock is truly worth. And that's where they get burned. But what if you could read between the numbers and confidently say, this stock is worth buying, and here's why? In this video, I'm going to walk you step by step through the exact methods professionals use to value companies, even if you've never opened a financial statement in your life. Stick around, because by the end, you'll be thinking like a seasoned investor. Let's get started. What is equity valuation? In simple terms, it's the process of estimating the real value of a company's shares. Equity valuation is the process of determining the intrinsic value of a company's stock. It's a method used by investors, analysts, and business owners to assess whether a stock is overvalued, undervalued, or fairly priced based on fundamental factors such as earnings, growth potential, and financial health. In simpler terms, it's like asking, what is this company really worth? Now, let's be clear, price is what you pay. But value is what you get. Valuation helps investors determine if a stock is overvalued, too expensive for what it offers; undervalued, a potential bargain; or fairly valued, just about right. And no, you don't need to be a financial analyst to understand it. It's about using simple tools to make sense of the numbers behind the stock. Let's see what those tools are. Section 2. Key inputs you need. Before you even start calculating anything, gather these key ingredients. 1. Financial statements. Income statement shows revenue, expenses, and profits. Balance sheet tells you what the company owns and owes. Cash flow statement shows actual money in and out. 2. Earnings metrics. EPS, earnings per share. Net income. Revenue growth. 3. Industry and economy. Is the sector growing? How's the competition doing? 4. Company-specific insights. Is it innovative? Does it have a strong brand or loyal customers? You can find most of this on Yahoo Finance, Google Finance, or the company's investor relations page. Section 3. Intrinsic versus relative valuation. There are two main ways to value a stock. Intrinsic valuation. You look inside the business, future cash flows, assets, and fundamentals. Relative valuation. You compare it to other companies in the same industry using ratios. You need both to get a clear picture. Intrinsic tells you the actual worth. Relative tells you how it stacks up in the market. Section 4. Discounted cash flow. The DCF method is one of the most reliable and most intimidating for beginners. But let's simplify it. You're basically asking, how much money will this company make in the future, and what's that worth in today's terms? Step 1. Project free cash flows, FCF. Estimate earnings the company will generate for the next 5 to 10 years. Step 2. Choose a discount rate. Usually the weighted average cost of capital, or WACC. It accounts for risk and time value. Step 3. Calculate terminal value. The value of all cash flows beyond year 10. Step 4. Discount everything to present value. Add it up, and you've got the company's estimated intrinsic value. It sounds technical, but once you do it once or twice in Excel, it becomes second nature. Section 5. P/E ratio explained. The price-to-earnings ratio, PE, is one of the most widely recognized and frequently used valuation metrics in the world of investing. It gives investors a quick snapshot of how much they're paying for each dollar of a company's earnings. Formula PE equals price per share earnings per share, EPS. Example, if a stock is trading at $100 and its earnings per share, EPS, is $5, then PE equals 100, 5 is equal to 20. This means that investors are willing to pay $20 for every $1 of the company's earnings. Interpretation: a high P/E ratio might indicate that investors expect high growth in the future. This is common with tech stocks or high-growth startups. A low P/E ratio might suggest the stock is undervalued, or it could indicate that the company is facing challenges and investors expect lower future earnings. Context matters. A P/E ratio should never be viewed in isolation. It's crucial to compare it with the company's historical P/E ratios, the average P/E ratio of its industry peers, the overall market P/E average. For instance, a P/E of 20 might be high for a utility company but low for a fast-growing tech firm. Limitations: the P/E ratio is based on accounting earnings, which can be manipulated or vary due to one-time events. It's less useful for companies with negative earnings, where the ratio becomes meaningless. Doesn't account for growth rates. Two companies with the same P/E may have very different growth prospects. Section 6. Price-to-book ratio, P/B. The price-to-book, P/B, ratio is a financial metric that compares a company's current market price to its book value. The book value is essentially the value of a company's assets minus its liabilities, what would be left for shareholders if the company were liquidated. Formula: P/B equals price per share or book value per share, where price per share is the current trading price of the company's stock. Book value per share is the company's total equity divided by the number of outstanding shares. Why it matters: the P/B ratio is especially useful for valuing asset-heavy companies, such as banks, insurance companies, real estate firms, industrial companies with significant physical assets. Interpretation: a P/B ratio of 1 means the stock is trading exactly at its book value. A P/B ratio greater than 1 means the stock is trading above its book value. Investors believe the company is worth more than its assets. A P/B ratio less than the 1st of May signal undervaluation, implying the stock might be a bargain. However, it could also indicate deeper issues, such as poor future earnings potential or weak asset quality. Use with caution. While a low P/B ratio might look attractive, context is key. A low P/B could mean the company is in financial trouble. Assets are overvalued on the books. There are industry-specific risks. Best practice: always compare the P/B ratio of a company with others in the same industry, and combine it with other metrics like ROE, PE, and debt ratios for a clearer picture. Section 7. EV/EBITDA ratio. The enterprise value to EBITDA, EV/EBITDA, ratio is a widely used valuation metric that gives you a clearer picture of a company's true value by accounting for its capital structure, debt and cash, unlike other metrics that focus solely on equity. Formula: EV/EBITDA equals enterprise value d/EBITDA, where enterprise value, EV, equals market capitalization plus total debt, cash and cash equivalents. EBITDA equals earnings before interest, taxes, depreciation, and amortization. Why it's powerful: EV/EBITDA strips out the noise of non-operational factors like interest payments, which depend on capital structure, taxes, which vary by jurisdiction, depreciation, amortization, which can differ by accounting rules. Interpretation: a lower EV/EBITDA generally indicates a cheaper or more undervalued company. A higher EV/EBITDA could mean the stock is overvalued, or that the market expects higher growth. Best use: great for comparing companies within the same sector. Particularly useful for acquisition analysis, because EV reflects the total cost to acquire a business. Section 8. Dividend Discount Model, DDM. If you're analyzing dividend-paying stocks, the Dividend Discount Model, DDM, is one of the most fundamental and effective tools for valuation. It's based on the principle that a stock is worth the present value of all future dividends it will pay. Formula: value equals D/R/G, where D equals expected annual dividend per share, R equals required rate of return, your minimum acceptable return, G equals dividend growth rate. Example: if a stock pays a $2 dividend annually, you expect a return of 8%, 0.08, and dividends grow at 3%, 0.03, then value equals 2, 0.08 to 0.03, equals 2, 0.05 equals $40, so the intrinsic value of the stock is $40. If the stock is trading below this, it may be undervalued. Best use cases: mature companies with consistent dividend histories, like Coca-Cola, Procter & Gamble, Johnson & Johnson, utility and consumer staple companies that provide regular dividend payouts. Limitations: not useful for companies that don't pay dividends. Highly sensitive to the growth rate and required return, small changes can skew the valuation. Assumes constant growth, which may not always be realistic. Pro tip: always double-check your inputs, dividend growth, required return, and use conservative estimates to avoid overvaluation. If you found this valuable, hit the like button and subscribe for more financial breakdowns. Got questions? Drop them in the comments, we reply to everyone. Thanks for watching, and happy investing!